Let's be honest, most of us treat our retirement accounts like that messy kitchen drawer we avoid opening. We know it's important, but it's easier to ignore the mess than to face what's really inside. We stuff in statements, old receipts, and hope that somehow everything will work itself out by the time we need it. But now, even the calmest voices in finance, like Vanguard, are sounding alarms about the US stock market. When the experts who usually urge patience start to worry, it's time to pay attention. Vanguard, which manages trillions of dollars for millions of investors, is warning that US stocks are likely to return just 4.2% to 6.2% annually over the next decade. That's a big drop from the double-digit returns many of us have come to expect, and it could mean your nest egg grows much slower than you planned. After inflation, your real returns could be disappointingly low. That means the money you're counting on for retirement might not stretch as far as you hoped, especially as the cost of living keeps rising. The era of just buy the index and forget it may be ending. What worked for decades might not work in the years ahead, and simply riding the market could leave you short. The global financial landscape is shifting, and America's dominance is being challenged. The world is no longer looking to the US as the only game in town. Other countries are building their own systems, chipping away at the foundations of the American-led order. New financial centers are rising, and global trade is being reshaped in ways that could impact your investments. This isn't just about numbers, it's about the stability of your savings and your future. Your ability to retire comfortably, help your family, or weather emergencies could all be at risk if you're not prepared. The old rules are breaking down, and ignoring these changes could be costly. What felt safe yesterday might be risky tomorrow, and the headlines are starting to reflect that uncertainty. Over the next few scenes, we'll break down what's happening. From overpriced stocks and a weakening dollar, to the forces that could reshape your financial future. We'll look at why the market feels so different now, and what you can do to protect yourself. We'll also explore the rise of new global powers, and how their growing influence could affect your retirement savings in ways you might not expect. Because pretending nothing's wrong is like ignoring a doctor's warning, you might regret it. It's better to face the facts now, even if they're uncomfortable, than to be caught off guard later. So let's open that drawer together and see what's really inside. It's time to get honest about your 401k, your future, and the new financial reality we're all facing. When Vanguard, one of the world's largest investment firms, warns that US stocks are overvalued, it's like walking into a thrift store and seeing a used toaster priced at $500. You'd probably laugh, shake your head, and walk away. But in today's market, that's exactly what's happening. People are lining up to pay sky-high prices for things that may not be worth nearly as much. Just because everyone else is eager to buy, doesn't mean it's a good deal. The crowd mentality can be powerful, making us feel like we're missing out if we don't join in. But sometimes the crowd is running straight toward a cliff. Stock prices have soared to record highs, and it's not always because companies are making more money. Often it's driven by hype, speculation, and the fear of missing out. Investors are piling in, hoping to catch the next big wave, but sometimes that wave is just froth. The S&P 500's price-to-earnings ratio is now in the high 20s, much higher than its long-term historical average. This means investors are paying a hefty premium for every dollar of earnings, betting that future growth will justify today's prices. You're not just paying a little extra, you're paying top dollar for growth that may or may not materialize. It's like buying a ticket to a show that might get canceled. The CAPE ratio, which averages earnings over a decade to smooth out the noise, is flashing warning signs. It's at levels we've only seen before the dot-com bubble burst in 2000 and the infamous crash of 1929. History doesn't repeat exactly, but it often rhymes. That doesn't guarantee a crash is coming tomorrow, but it's a huge red flag that investors should not ignore. It's a signal to be cautious, not complacent. Meanwhile, corporate earnings have stagnated or even declined in some sectors, yet stock prices keep climbing higher. The disconnect between what companies are actually earning and what investors are willing to pay is growing wider by the day. In other words, we're paying tomorrow's prices for yesterday's performance. That's a risky bet, especially if the future doesn't turn out as rosy as everyone hopes. When optimism fades and reality sets in, the fall can be sudden and brutal. History shows that markets can turn quickly, leaving latecomers nursing heavy losses. Investors who buy at these inflated prices could face years of poor or even negative returns, waiting for valuations to come back down to earth. The gap between stock prices and economic reality is growing ever wider, and that's a warning sign for anyone paying attention. So, as the music plays and the party rages on, it's time to ask, is the celebration about to end? Are US stocks on steroids? And if so, what happens when the high wears off? The US dollar has long been the world's financial superstar, serving as the backbone of global trade and investment for decades. Its influence stretches from bustling markets in Asia to the financial hubs of Europe, making it the currency of choice for governments, businesses, and individuals alike. This dominance has given America a huge advantage, allowing it to borrow cheaply, run large deficits, and project economic power across the globe with relative ease. But now, that dominance is fading. The dollar's share of global reserves has dropped from over 70% to just 58% in the past 2 decades, a significant decline that signals a shift in the world's trust. Central banks worldwide are quietly moving away from the dollar, diversifying their reserves into euros, Chinese yuan, and even gold. This trend reflects a growing desire to reduce dependence on the US and protect against potential risks. Why is this happening? The US has increasingly used the dollar as a weapon, imposing financial sanctions on countries it disagrees with. These actions have made other nations nervous about keeping their assets in dollars, fearing they could be frozen or seized at any moment. As a result, many countries don't want their economies at the mercy of Washington's political decisions. They're seeking alternatives to safeguard their financial futures. On top of that, America's ballooning $34 trillion national debt is raising eyebrows. Foreign investors are increasingly worried about the country's ability to manage its finances responsibly. The US government's habit of printing more dollars to finance its debt only adds to these concerns, as it devalues existing holdings and erodes trust in the currency's long-term stability. Now, foreigners are openly questioning whether the dollar is still the safe haven it once was, or if it's becoming a riskier bet in an uncertain world. As currency markets grow more volatile, the world is starting to see the dollar not as a sure thing, but as a gamble that could backfire. America's so-called exorbitant privilege, the unique benefits of issuing the world's reserve currency, is now under serious threat. The global financial order is shifting, with major economies exploring new ways to trade and invest without relying so heavily on the dollar. The consequences for US power, and for your wallet, are real. A weaker dollar could mean higher prices, more expensive imports, and a loss of economic influence for everyday Americans. The dollar's golden age may be ending, ushering in a new era of uncertainty for the world's financial system. The decline of the dollar isn't random, it's a coordinated global effort called de-dollarization. Countries like China and Russia are leading the charge, tired of US financial dominance and sanctions. The BRICS bloc, now including oil giants like Saudi Arabia, is building a parallel financial system. They're trading in local currencies, bypassing the dollar. China is pushing the yuan, launching a digital version and its own payment network, CIPS. If the world needs fewer dollars for trade, demand for our currency drops. That means higher borrowing costs and tough choices for the US. Cut spending, raise taxes, or face a debt crisis. America's era of easy credit, subsidized by the world, is ending. The global financial game is changing fast. A weaker dollar isn't just a headline, it hits your wallet directly. When the dollar falls, everything imported gets more expensive. Phones, clothes, cars, even groceries. Companies pass higher costs on to you, fueling inflation. Your paycheck buys less, and your savings lose value. International travel gets pricier, and so does gas, since oil is priced in dollars. This is already happening. Just look at rising prices everywhere. A weaker dollar is a hidden tax on your lifestyle. It erodes your purchasing power, making everyday life more expensive. The impact is real, and it's not going away soon. Protecting your money means understanding these shifts. The classic 60/40th portfolio, 60% stocks, 40% bonds, used to be the gold standard. But now, both stocks and bonds can fall together, leaving you exposed. US stocks are overvalued, limiting future returns. Bonds are risky too, with high debt and inflation eroding their value. The safe part of your portfolio could actually make you poorer. Experts now recommend looking beyond the US. International stocks, especially in emerging markets, offer better value and growth. The old strategy is a trap in today's world. Diversification is no longer optional, it's essential. Don't let nostalgia for the past cost you your future. It's time to rethink your investment playbook. US Treasury bonds were once the world's safest investment, funding our government at low rates. But major buyers like China and Japan are cutting back, reducing their exposure to US debt. The Federal Reserve and domestic investors are picking up the slack, essentially printing money to buy our own debt. This creates a dangerous cycle. More dollars in the system can fuel inflation and make our bonds even less attractive. With fewer foreign buyers, the US must offer higher interest rates, making borrowing more expensive. That means higher taxes or cuts to services like infrastructure and healthcare. It also means higher costs for mortgages, car loans, and credit cards. The era of cheap debt is ending. The consequences will be felt by every American. Our financial safety net is fraying. The world's appetite for our IOUs is fading fast. As the US-led order weakens, the BRICS bloc is rising to challenge it. With new members like Saudi Arabia and the UAE, BRICS Plus now controls a huge share of global population, GDP, and energy. They're building their own financial system, trading in local currencies, funding projects through their own development bank, and moving away from the dollar. The inclusion of major oil producers is a game changer. If oil starts trading in currencies other than the dollar, global demand for our currency could collapse. This is a historic shift in global power. The unipolar world is ending. We're entering a fragmented, competitive era. For Americans, this means economic stability is no longer guaranteed. Risks are rising. Expensive stocks, a weakening dollar, persistent inflation, and new global alliances. The world is moving on, and we need to pay attention. Adapting is no longer optional. Your financial survival depends on it.